Good day, ladies and gentlemen, and welcome to the Q2FY23 earnings conference call of IIFL Finance Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rajesh Rajak, Chief Financial Officer. Thank you, and over to you, sir.
Good day, everyone. I'm Rajesh Rajak, Chief Financial Officer. Thank you all for joining us on this call. On behalf of the entire team at IIFL Finance, I would like to extend best wishes for Diwali and a very prosperous new year ahead to all of you. On this call, I'm accompanied by Mr. Nirmal Jain, our Managing Director, Mr. Monu Ratra, CEO of IIFL Home Finance, Mr. Venkatesh N, CEO at IIFL Samasta Finance, and Mr. Kapish Jain, Deputy CFO and Head Investor Relations. I'll hand over to our Managing Director, Mr. Nirmal Jain, to comment on the economy and the group's overall strategy and plans. Over to you, sir.
Thank you, Rajesh. And I think all of you had a good Diwali. And I wish you and your family and loved ones a very happy Samvat New Year. So to begin with, I think India's macroeconomic fundamentals are very strong. India stands out as the bright spot in a gloomy world. I mean, this is where investors can expect visibility of earnings growth, political and economic stability, favorable demographics, and something that is not talked about much is the fact that India has leapfrogged the rest of the world to build the best-in-class digital infrastructure for 1 billion people to ride on. And the sector that is most impacted and is crucial for economic growth is financial services. India has come a long way on the agenda of financial inclusion. Still, finance and credit have not reached several million. All the bank branches network still is not able to reach out to all the needy borrowers. And there's a growing realization amongst the policymakers that banks and NBFCs have to work together to achieve the goals of financial inclusion quicker. And fintechs have a role to play as well. But there are thousands of fintechs that are mushroomed all over, so it's no-brainer that there will be high mortality there. RBI has been regulatory guidelines to prevent systemic issues by unbridled credit products from non-regulated entities. In fact, RBI's timely intervention is the biggest shot in the arm for fintech industry. And the orderly growth of fintech will facilitate breakthrough innovations and solutions for credit to the masses. And our PM said it very rightly a few days ago, that fintech will lead to financial revolution. Coming to IIFL Finance, I think we are in the sweet spot to seize the opportunity and participate meaningfully in India's financial inclusion drive. Besides in-house team driving digital innovation and innovative solutions, we have brand, balance sheet and branches. I believe that we are at the cusp of unprecedented growth opportunity, and we augment our organic effort to acquire new customers through partnerships such as Open Money and very recently Just Money to reach out to the underserved customers and access their data with consent for instant loans. We continue to look for alliances and innovative partners. And for balance sheet, we continue to partner with banks through co-lending and direct assignment. Last quarter, our co-lending book grew 22% quarter on quarter. This quarter, I think, is a watershed quarter in my opinion because our differentiated strategy of retail on one hand and the partnership on the other hand is getting vindicated by the performance and perceptible potential. Our vision is to be the most respected non-bank in India for innovation, quality, growth, customer centricity, and not only meeting but exceeding all the stakeholders' expectations. So last quarter, we achieved healthy profit growth. But more importantly, we also improved our asset quality and we reduced our gearing further. And this quarter, we are taking the standards even higher. We have added a section with business and financial details of all group entities, namely the holding company, the NBFC IIFL, the housing finance company and the microfinance company as well separately, and reconciliation to show how they are consolidated in the reported numbers. So thank you. With this, I hand over to who is our Head of Investor Relations. Thank you.
Okay. A brief
So Rajesh will continue or Rajesh is continuing. Thanks.
Our IIFL Finance's profit after tax, pre-non-controlling interest for the quarter was the highest ever at rupees 397 crores, which is up 36% up on a year-on-year basis and 20% up quarter-on-quarter. This was driven largely by volume growth and lower credit cost. We recorded pre-provision operating profit of rupees 685 crores during the quarter, which was again up to 23% up on a year-on-year basis and 2% up quarter-on-quarter. Loan AUM grew by 25% year-on-year and 5% quarter-on-quarter to rupees 55,302 crores. Our core products grew faster at 28% year-on-year and 5% quarter-on-quarter to 52,221 crores, driven main ticket home loan, gold loan and microfinance loans. Our non-core loan AUM, primarily construction and real estate financing, shrank by 9% year-on-year in line with our strategy. 95% of our loans are retail in nature and 69% of our retail loans are PSL compliant, which is excluding gold loans which are not classified as PSL loans under extant RBI regulations. The large share of retail and PSL compliant loans are of significant value in the current environment where we can sell down these loans to raise long-term resources. In line with the capital optimizing strategy, 39% of our AUM is either assigned, securitized or under co-lending as of September 2022, which is up from 35% during the same period last year. During the quarter, IIFL Finance tied up with South Indian Bank and Karur Vysya Bank for co-lending of gold loans and Indian Bank for business loans. During the half year, we added over 450 branches and over 4,000 employees. As a result, cost to income ratio has increased to 43% from 40% last year, but this paves the way for accelerated growth in the future. Annualized return on equity for the quarter just ended is at 20.4% and the annualized ROA is at 3.4%. Our capital adequacy ratio is at 21.7%, which is well above the statutory requirement of 15%. As a result of the improved credit profile of the company, our quarterly average cost of borrowing declined 3 basis point quarter and 29 basis point year-on-year to 8.4%. Gross NPA stood at 2.4% and net at 1.2% as at September, which is down from 2.6 and 1.6% respectively from the previous quarter. Our provision coverage on NPA is now 147%, which is up from 137% in the previous quarter. Earnings per share for the quarter, not annualized, stood at rupees 10 per share, which is up 30% on a year-on-year basis in line with the increase in profits. And book value per share is at rupees 215.2 rupees, which is up 41% year-on-year. A brief update on liquidity. During we raised approximately 3,800 crores in debt, and in addition we assigned loans worth 3,500 during the quarter. Our cash and cash equivalents and committed credit lines from banks and institutions of rupees 8,191 crores were available as at the quarter end, adequate to meet not only the near-term liabilities but also to fund the growth momentum. We have a positive ALM whereby inflows cover or exceed expected outflows across all buckets. Our net debt to equity ratio is at 3.1x, which is down from 5x as on September 21. IIFL Home Finance, a subsidiary, received rupees 2,200 crores from ADIA in August 2022, thereby boosting the net worth of IIFL Home Finance by more than 80%. This will help the company consolidate its competitive position in the affordable housing finance market in India, which has tremendous long-term growth potential. This also gives us a gunpowder to tap the growth opportunity in the housing segment. With affordability index at a decade high, we believe that the dip in the rate will be well absorbed by the customer with marginal hiccups. The total equity of the group now stands at rupees 9,480 crores. IIFL Finance has entered into a partnership with Zest Money, which is India's leading and fastest growing digital EMI checkout financing platform, to offer credit to potentially millions of new to credit customers. Through this industry first partnership, IIFL Finance as a dedicated partner will get access to a new customer base on the Zest norm and play a crucial role in driving financial inclusion for a large section of people in the country. A little bit of digital updates. We continue to focus on digitization and analytics to improve customer experience and enable a convenient one-stop shop for credit and investment needs. During the previous quarters, we had mentioned about DIY digital initiatives for disbursement through WhatsApp and My Money. More than 60,000 customers have been onboarded till date under these initiatives. During the quarter, the DIY disbursements were 352, up 36% quarter on quarter. Our gold loan at home initiative, which started approximately a year ago, also saw significant traction with disbursements increasing 118% year-on-year to 227 crores during the quarter. The IIFL Loans app and My Money app is being increasingly used by our customers for various transactions, and thereby giving customers ease and convenience. We have more than 3,000 average active users, monthly active users across both these apps. With this, come to an end update, and we can now open the floor to questions. Thank you.
Thank you very much. Sir, before we could go ahead, sir, there is a slight disturbance which is coming along with your voice.
Okay. Is it better now?
Yes, sir, much better.
I think this is the same instrument we've been using for several quarters. I don't know.
Yes, sir.
Why there's a problem. Let's start Q&A. We'll try and be a little louder and specific.
We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Harsh Shah from L&T Mutual Fund. Please go ahead.
Yeah. Good afternoon, gentlemen, and congratulations for such a strong quarter. Just first question is on the opening remarks that Rajesh just said. You had mentioned that overall cost of fund has gone down. Can you just explain how?
Hi, Harsh. Because 2-3 things which are responsible for this. Number one is, we have bought back approximately $100 million worth of our overseas bonds and replaced them with low-cost rupee financing under ECB. So basically, we have had a gain on that. And if you remember, our second lot of buybacks we had done at a lower than par also. And increasingly, what we are seeing is our off-balance sheet funding, which is loan assignments, which was 35% last September, has now become 39%. So that also gives us significant advantage because the direct assignment, because of the stronger asset, comes in at a lower cost of funds. So it's really a combination of all this. Also, Samasta Microfinance approximately a year ago got upgraded. The credit rating got upgraded from A+ to AA-, which is, I think, probably just 1 or 2 MFIs in the whole country to have that rating. So it's really a combination of all these factors that have contributed to the stable cost of funds till now in a rising rate environment.
So if I just remove the co-lending and off-book funding that you get, like I'm just referring to a PPT in which you have given.
And the primary thing is that dollar bonds were very expensive because the fully hedged cost was about 10% actually, maybe closer to 11. The dollar bond that we raised in February 2019 in the wake of liquidity crisis. So what happens is the hedging also, as we repay the dollar bond, we can remove the hedging also. So the total cost comes down significantly. I mean, as I said, it's like a kind of cost that we can replace with, even if 8.5, 9, we save money.
And Harsh, the entire bond is anyways due for maturity in April 23. We have adequate liquidity to repay that. And with that slightly higher cost borrowing going off the books, we should see more stability in the forward-looking.
If given the opportunity, we'll probably try and buy back the entire thing, but it makes sense. So.
Understood, sir. And second question is, you have done some small accounting change this time. You had mentioned it in your P&L that co-lending, the spreads on co-lending has been now classified under non-fund based. So can you just help us understand how that works?
So, So in case of co-lending, suppose we are lending % and banks basically have, their share is 9%. So then what happens that the accrued in a quarter, supposing the total interest is 15, the difference basically goes as a non-fund income because assets are, okay. So on the 20% component, we'll account for 15% interest as interest income. On the remaining 80% account of component what banks have, the 6% for the quarter will go as non-fund based income. So, when we just started, the entire thing was being taken as interest income, but now we are trying to adjust it. Because of if you understand the underlying assumption that because 80% assets are not on our books.
Correct.
And the risk is also
20% will go into interest income and rest 80% side will go into non-fund based.
All right. And now the co-lending is becoming significant, so it might become visible. But the remaining 80%, the difference of the excess interest or our share will go as non-fund income.
Understood, sir. And just last question from my side. I mean, AUM growth, you have been quite vocal of maintaining at current run rate, plus minus few basis point. But considering how strong your ROA was in this quarter, do you think for the balance of at least H2, you will maintain it, or is there also further scope of increase in this ROA?
I think we should target to maintain it, given the fact that there will be upward pressure on the interest cost also, and liquidity has tightened significantly in the system now.
Understood. And has there been any changes in your OpEx strategy? Because even OpEx as a percentage of asset has been inching upwards. OpEx as a percentage of total AUM.
OpEx as a percentage of total AUM has gone up because of the branch expansion that we have done very aggressively, and that has continued through the.
I'm sorry.
So, but it's now it's going to plateau.
Sorry to interrupt. Sir, we couldn't hear you. Can you please repeat your last line?
No, I'm saying that the OpEx had gone up significantly because we had large number of new branches, almost 400, 500 new branches going, commissioning in last quarter. The full impact of cost comes in this quarter. But going forward, it should plateau and should start coming down as we slow down the pace of branch expansion.
Understood. That's it from my side. Thank you very much and all the very best.
Thank you.
Thank you.
The next question is from the line of Sukriti Jivarajka from Laburnum Capital. Please go ahead.
Hello.
Go ahead.
Hi. Congratulations on a strong quarter. Congratulations, Kapish, on joining the team. My first question is on gold loans. So, this is one of the core segments that you highlight for growth. And while the sort of price competition that we saw last year between NBFCs has abated a little bit, you do see banks, especially HDFC Bank, saying that now we want to expand gold across our branches. Let's say in Maharashtra, we want to take gold from 1,500 branches to 3,000 branches in the next 2 years. So this will impact, and there has been we've discussed in the past where you say that banks can't do gold loans like NBFCs can. But when a large bank comes and says that no, we want to expand consumer gold loans to so many more branches and have the gold valuer every day in the branch, it will impact you in one of two ways, either growth or the sort of the 15 to 20% yields that you earn in gold today. Because they'll probably do it at 13%, 12%. So, what do you think about that? Am I seeing this wrong? And if yes, then how would you counter that?
I think the point is valid, and that is what is seen in the gold loan business results of ours, of gold loan companies as well. So if you see, our growth is very modest given the fact that we expanded our branch network 40% in last 18 months. But quarter-over-quarter, we have been able to manage just 4% growth. So either you compromise significantly on yield or your loan growth will be muted because of intense competition from banks. But if you look at last 10 or 12 years history, then what happens is many times we have seen this, that NBFCs and fintechs basically they jump in because it looks like that the NIM is very high and very attractive for a relatively zero risk kind of a business. But typically gold loan operating cost is maybe around percent for a relatively mature kind of a business of the loan AUM. So it's not that the margin of of any interest rates of 16 to 18% exorbitant, but either from a bank's balance sheet, I don't know how they do the accounting, but if they do it, then probably people discover. Also, it's very vulnerable to frauds and robberies and many other things. Now, if you go back 6 months or 12 months, then most of the banks are scrambling for retail assets and loan growth. And, that is the time probably most of the banks also jumped onto this. But this is a small ticket loan item where the growth is not so rapid. Already what we have seen is that many new fintechs and new NBFCs that were doing the loss leading kind of price offer like 54 paisa, which means around 6% or 7% per annum, they already withdrawn. So I think that the sense has already started to prevail in terms of the competition. In terms of banks also, we try and target the regions and geographies which are not easily accessible to banks even now. At least a new branch focus will be on that. It's a neighborhood business, like supposing nobody goes from Andheri to Virar to take gold loan. So we have to work out our strategy, and we are also working on a strategy to make sure that the cross-sell fee income and all those things increase through these customer base significantly. But your point is valid, that the competition is intensified and banks, becoming very aggressive, impact on the yield and the growth.
Got it. Got it. The second question is on the assignment income. Now, this 418 crores of assignment and co-lending, have you divided this anywhere between how much is from assignment and how much is from co-lending?
Maybe as a good point, maybe from next quarter we start, or maybe we'll try and figure out how do we disclose that separately. But at this point in time, so what happens is that even in co-lending or even in assignment, maybe we have to divide it into the upfronted portion, the NIM portion, and then the amortization and the fee portion. So we will work on these numbers, but at this point, right now I don't have it with me.
Yeah. So the declining trend is probably because a lot of the upfront is turning into amortized. I think that would be it. Correct?
Yeah. Can you repeat, please?
No, I'm saying there was a slight declining trend in overall income from assignment.
Yeah, I think the declining trend is understandable because in co-lending we are not upfronting anything, doing interest as it is received every quarter. But in case of assignment based on Ind AS accounting policy, you make some conservative estimate, and because the risk is off your balance sheet, so you try and upfront. Basically you end up upfronting the discounted value of the income. So as we move from to co-lending more and more, the upfronted portion will keep reducing and the flow of interest income on the accrual basis will increase.
Got it. Makes sense. And also the write-offs this quarter, we didn't see anywhere in the PPT. Maybe I missed it.
Write-offs and provision for losses, the loan losses, provisions and write-offs are all together in that amount of 196 crores.
No, what is the write-off?
No, we don't have any write-offs as such. Or not taking significant. 58. So 58 crores is the write-off in total.
Okay.
No, sorry. Just 1 second. Let me confirm. Sorry, 59. Hello?
Yeah.
Hello?
I can hear you.
Hello? Yeah. No, I think the amount is all included in the fixed.
Okay.
Hello? Yeah.
Yeah. Okay. Also, you just mentioned to the last, the person who came before me, that this dollar offshore bonds have been replaced, which was a reason for the cost remaining where it is, or actually going down a little bit. How much of today's borrowings now are these dollar offshore bonds, and how much are you looking to replace over the next few quarters, years, and what sort of cost of funds advantage can we get from that?
So dollar, there are two types of dollar exposure that we have, and they will all both help. So one is a dollar bond issue that we did, which is kind of a public offering kind of issue, where you open, get the bids and do that. So that was about $400 million that we did in February 2019. Out of which about 100 or maybe a little over than 130 we already bought back. So the outstanding will be 270, anywhere between 250 to maybe around 270 is the outstanding out of that issue. And then there are ECB loans which you really can't repay because you can buy back. See, these are the listed bonds, these $400 million that we did in Feb 19. And the listed bonds, you can, try and whenever the market... See, today, if you see the yield on all emerging market bonds has gone up. Even good quality banks also are available at a very attractive dollar yield. So this 400, 130 we have bought. 270 is still outside, which, I mean, we'll try and buy back. If you don't, then we have to repay in April 2023.
Okay.
Does this answer? Okay, thanks.
Yeah. I have one more question, if I can.
Yeah, please go ahead.
So actually, business loans had a particularly good quarter. The growth run rate went up, NPAs came down. You also provided more for this book. There was that arrangement with Open last quarter. Is this something now that you would say this is in your sort of core growth segment? Because traditionally you used to always talk about home loans, gold loans and MFI as your core segments. Where is business loans? How do you think about it in terms of growth? And what are these? Are these term loans or are these working capital loans? Or are these LAP loans?
So this is the core segment for growth for sure. So I think we'll have 4 core businesses, which is home loan, gold loan, microfinance and business loan. And within business loan, the larger loans we target the property against the proper collateral of property, and the smaller loans we look at unsecured. Now, typically, all the loans basically they're all term loans, and we really don't do OD or overdraft like banks do. But these term loans are also taken by these businesses for working capital requirement. Primarily, for unsecured loans, we primarily for working capital requirement. So if you look at the average ticket size of our loan, incrementally is around. The unsecured loan will be around 4-5 lakh rupees, and all put together, the ticket size has been coming down. It's 61 lakh rupees the last quarter, but incrementally is around 10 to 20 lakh rupees. So what has happened is historically we had a larger LAP. That business we discontinued. So quarter after quarter you see that this is coming down, and so these are all small businesses like shopkeepers, traders, these freight operators, or sometimes some these. Self-employed professionals or people who are self-employed non-professionals, all the people who are running any kind of business, and these are all typically small businesses. So that is what we'll be targeting, as a core growth thrust, and open partnership and all the many other partnerships that we look for is this kind of business.
You're actively doing unsecured in the business loan segment today.
Yeah, unsecured split we again, but yeah, we are doing unsecured also. So if you see the quarter 70 is a split is 75-25. 75% is secured and 25% is unsecured in our book currently.
And in the disbursement?
It's still okay. You know what happens? Disbursement unsecured may be slightly more, but the tenor is shorter. So probably in terms of portfolio is 75-25. Disbursement may be sort of 2/3, 1/3.
Okay, thank you so much.
Thank you. The next question is from the line of Anusha Raheja from Dalal & Broacha. Please go ahead.
Yes, thanks for taking my question. Just wanted to understand, how do you see the growth panning out, for the balance part of the year?
Sorry, your voice is not clear, Anusha. Can you just be a little, can you speak again?
Can you please use your
Yeah,
hand?
just a second. Yeah, am I audible now?
Yes.
Yeah.
Please proceed.
Yeah, I'm saying, how do you see growth panning out for balance part of the year?
Balance part of the year, growth.
Like, so far we have seen a very good...
Yeah, I think the balance part of the year should be equally good or better, but there's no reason for, I think we should be able to sustain the growth and margins both. And right now the environment is looking very positive in terms of demand for credit and the bank's willingness to partner. And the economy is doing well. So actually most of the businesses are coming back on track, and they take, business loan as well as gold loan. Even in a real estate sector, the interesting thing is while the interest rates might have gone up, but they have not slowed down because the builders have kept the nominal prices down or they have not increased the prices. So because they are also trapped and they want to basically, sell and liquidate. So we are seeing good demand for all businesses. Microfinance also has picked up very well, and the entire industry has picked up very well in last quarter. So I think it looks like the outlook for the next 2 quarters as well.
Okay. And what were the margins, in Q2?
Margins?
Yes, what were the margins for the Q2?
You are saying net interest margin?
Yeah, net interest margins or the spreads?
Is around 8%.
It's around 8%. And, what are the incremental, yields and the cost of funds, if you have those numbers with you?
So the cost of fund, as Rajesh mentioned, that we have been able to bring it down in last quarter by a repayment of the high-cost dollar bonds. So they are flattish. It is not that, there's not much basis point decline. The yield on an overall level has gone up because the interest rates have gone up also. So the portfolio yield 0.5% for the quarter as compared to 15.3. So it's 20 basis point increase in the yield. And in the cost of funds, what is the decline?
Decline was about 10 basis.
Around 10 basis point decline there. So margins have improved by 30 basis points that way.
Okay. And just one last question. On the OpEx side, in last 1 or 2 quarters, 3 odd quarters, we have seen, sizable amount of branch expansion. So going forward, any outlook on the OpEx side? What are your plans to, roll out branches in terms of employee expenses? Any guidance there on the OpEx side?
So, see, branches that we expand, the operating cost should be double because our network has become much bigger. And last quarter, quarter-over-quarter, the OpEx increase was around 7%. Now, I think that, 4 to 5% is something that can continue for a couple of quarters, and then at, say, 23, 24, we will have to take a call on the strategy that we will continue with our branch expansion or slow it down. Now, that again depends on the business environment, because if you feel more confident and more positive that we can continue to expand the network and still maintain the return on assets, so then you need to expand the network. But at this point in time, it might plateau. It's not going to come down significantly, but it won't increase in any rapid manner also.
Okay, got it, sir. Thank you so much.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello.
Please proceed.
Yes, Deepak.
Thank you very much, sir, for the opportunity, and many congratulations for the great set of numbers. So I just wanted to understand more on the credit cost front. And now excess provisioning that we have been doing for last couple of quarters, driven by that RBI policy. So we are through with that, the excess provisioning?
So actually, we are pretty close to our guidance and whatever we have spoken that in terms of, so credit cost is coming down. Should continue the trend on a relative basis, relative to the portfolio or relative to the loan book. So I think we are on the right track there. If you see the more 36,000 crore loan on our book, 35,000 crore plus, and for a quarter, if you take 50 basis point, it's 175. But I think our credit cost this quarter is 196. So I mean, we are pretty close. So guidance is, it has to actually be around anywhere between 150 to 200 basis points in a year. And I think over next 2-3 quarters, we should move towards that. We are moving towards that, but we should reach there.
150 to 200 basis point credit cost. And this number is based on your on-books AUM, right? Not on total AUM.
Yes, this number is on-book AUM, not on total AUM. So what happens is that we have to worry about on-book AUM only and not on the total AUM.
Fair enough. Yeah. That's it from my side, sir, and all the very best. Thank you.
Thank you.
Thank you. The next question is from the line of Kashyap Zaveri from MK Investment Managers. Please go ahead.
Yeah. Thank you very much, sir, for the opportunity. And sorry to hop on this, but to the earlier question on co-lending, when this 80% of the book gets transferred to banks, I understand that the whole risk also transfers from our book to their book, if that's correct. And B is that
80%.
In which case.
Go ahead.
So in which case, the accounting of income will then be similar to what we do for assignments?
No, there's a difference because
we sort of amortize the income over the life of the asset which has been transferred.
Exactly. So here it gets amortized over the life of the, and whatever we do is based on the India's accounting and auditors guidelines. I believe that all the companies will do the similar way. So what is happening in case of assignment? Supposing you have a 7-year loan and let's say you are going to make a margin of 10. So what you'll do, you'll basically say 10 for 7 years, you'll discount it at present value.
Right.
Then you reduce the operating cost and they say 7 year, you'll say that behaviorally you think that 7 year might get repaid here. So then you take only for 4 years and you discount and you reduce the cost and then you upfront it. But in case of co-lending, it doesn't work like this. Basically it is that you'll accrue 10 every quarter, every year as it comes.
And the 8 that you pay out, you will account as the expense over there. And in the other income, you would do
no, you don't have to expect because interest directly goes to them from the customer.
Okay.
So money from the escrow is just straight away goes to the respective partner. Or we collect on behalf of the bank as an agent and give to them.
Okay. And just last clarification, in which case you, in the other income, you will account for only that spread, the differential.
That is right. On the 80% component or 90% or 70%. Now in co-lending also this percentage varies.
Okay. Yeah, got it, sir. Thank you so much.
Thank you. The next question is from the line of Darshil Pandya from Finterest Capital. Please go ahead.
Hello.
Please proceed.
Can you hear me, sir?
Yes.
Congratulations, sir, on this good number. Sir, my question is on the microfinance segment. It is contributing around 12% to the AUM. And, we have seen a year-on-year growth of 49%. And, we have come in from probably 840 crores in FY18 to 6,000 crores of AUM, in FY22. So do you see this number more getting up, contributing more to the revenues? Because, the market opportunity is very big, as we have mentioned in the investor presentation, and, we are putting up well. So where do you see this number going on, sir?
So this year's growth is basically because of the lower base of last year, because last year not grown. In fact, last 2 years have been little, so it's in a way catching up, and also we expanded the branch network. So I think that we would like to be a meaningful player in the industry. So we are amongst top 10, but we'd like to be amongst top 5 or top 3 for sure. So business will grow. I mean, the 49% or 25-30%, that is all matter of depending on how the new business is. But it'll grow. Our objective will be to grow a little faster than the industry, not too much faster and not too slow also.
Right. And, sir, also something on this gross GNPA and NNPA? It's
about the microfinance or overall business?
Yes, about the microcap.
So incrementally, we are seeing a good quality assets, and so our GNPA and NNPA will come down in this business unless something which is unforeseen or a black swan event happens again.
Okay. And any specific sector that we are giving up loans to microfinance segment?
No, not really, because we have branches in the suburbs of urban as well as rural areas. So primarily they go to these the women for cottage industries.
Oh, okay. That's it, sir. I just wanted to ask about this microfinance. Thank you so much, sir. We'll see you in the next quarter. Thank you.
Thank you. The next question is from the line of Nikhil Agarwal from Tusk Investment. Please go ahead.
Hi, can you hear me?
Yes, Nikhil, we can hear you.
Congratulations on a good quarter, sir. So I have one question on the investment book. So our investments book has added another 48 crores in this quarter. So can you explain, sir, what is the details of this increment in the investment book? I mean, in the terms of...
Sorry, can you repeat the question, please?
My question is on the investments book, sir.
Yes.
We have added around 1,400 crores of investments in this quarter. Can you explain the terms of this investment and what is the collection, the repayment status and recovery that we can get this investment book?
You're talking about 1,400 crore book?
Yeah. So, 1,200 crore has become 2,500 crore right now. So we have added another 1,400 crore.
Yeah. So actually, we got an Andhra bond of 500 crore, which is part of our liquidity, Andhra state bonds. And then there are SRs that some assets that have been transferred to ARC, and there's the AIF. So all these assets are valued every quarter based on the recoverability only, and mark-to-market wherever required is provided for. So we get them valued and rated every quarter by the auditors look at it, and I think rating agencies also do, CRISIL also does the assessment, and based on that we provide for mark-to-market. So value that you see is all recoverable.
Okay. And what is the interest rate and the return we can expect in this book? Because a lot of this book is also containing the AIF and the CRE book which we used to have.
Right.
And we aim to increase that to 3,600 crores. I think that was the guidance which was given by you.
Broadly, I think you can say that around for various instruments from 7 to 9%.
Okay. And is there any further details that you have on the book in terms of the asset qualities in the AIF?
So I think, okay, the real estate asset that we have transferred to AIF, they're doing better now because the environment has improved. And quality of the real estate part of it has improved. Even in the ARC assets, we had a reasonably good recovery in last quarter. So in a way, I think as the economy improves and the real estate sector improves, the asset quality is improving.
Got it, sir. I have one last question on the microfinance book. Sir, this quarter again we have seen some very high provisions similar to last quarter. And I think last quarter we had mentioned that a huge part of the restructured book had come out of restructuring. So how do you see this panning out going forward? Because the ROE in the business is now quite low, the half-year ROE. So
so I think, as I said last quarter also, that microfinance we have a pain, and the call that we took last year of giving moratorium and restructuring, as the book comes out of that, we are seeing that there are a lot of delinquencies there, and we are forced to take write-off in microfinance because above 90 is considered as you have to fully provide for that. I think this, and therefore the microfinance ROE is abysmally low to what historical trend has been. I think this will continue for another 2 quarters and will start tapering off, and probably I think we should be able to see a ban next year.
Kind of ROE
all the business that we do, our target is to have 20% ROE, and this is as of now depressing it, but we are working on it. Give us 2 more quarters for this.
Sure. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Jigar Jani from Edelweiss Wealth. Please go ahead.
Yeah, thanks for taking my question, and congratulations on a great set of numbers, and a happy new year to everybody. So my question is on the stage 2 assets, that especially in the gold loan side. So starting from Q4 onwards, if you see stage 2 assets on the gold loan side, they have gone from 4.9% of the gold loan book to almost crossing 11% now. Any particular reason why we are seeing this such a sharp rise, especially in gold loans on the stage 2 side? Even on an overall basis, that is pushed up our stage 2 assets from 5.5% in Q4 to almost 7%. So any color on that, why there is such a increase? Also, same is seen partly in home loans. to some extent, not as sharp as gold loans, but quarter-on-quarter, we are seeing increases in Stage 2 assets.
So the Stage 2 in the gold loan has gone up from 662 to 843, quarter-on-quarter. Partly because of the book growth and partly, in the festival time and in this time, sometimes the collection gets a little bit delayed. So there's some psychology in customers and the industry, the way they operate, that they try to collect it, they know that 90 days is allowed kind of a thing. So you see the Stage 2, but normally, typically, because there's a gold collateral and the risk to the customer also. So they don't go beyond 90. But it's just question of collection efficiency and putting a little bit more pressure on the system to, track it carefully. But, it's gone up a little bit with the book also and with, maybe some bit of, collection delays. And typically, people know that, okay, the customer no default, gold is with us. There are some technical, some cash flow, this thing, so we give him some. So normally people don't force, till the 90 days, to get to regularize the account. Customers can be sometimes lax on the employees, but your point is noted that, it's something which is, thanks for bringing to our attention, but that's the reason.
Right. And for home loans also is the same case?
Home loan has a slight increase with the book growth also. So I don't think there is any, from 415 to 504, that's what you're talking about, right? That's in a flow, but that's not very significant.
So,
the book is much larger. Thanks.
So is it possible to share the 1 DPD plus for the home loan book?
Maybe for all businesses. Right now we don't have it, but I think I'll note the point that whether we should have 1 DPD plus as a separate this thing.
Sure.
And in home loan is broadly around 1300 1 DPD plus.
1300. Okay. Understood. Thanks. And just last, if this early indicators of Stage 2 go up, say this is only for our own book, which is on book, but I believe similar performance will be replicated on your assigned book or your co-lending book. So does it impact your ability, or are there any repercussions on the asset quality or credit cost side for us? VA, I know it's fully risk off, but on the co-lending side, are there any clauses wherein if the asset quality deteriorates, especially for books that we have originated, we need to provide more or share more of the risk or something of that sort?
So now the quality and these are all within the acceptors. So at this point in time, I don't see any stress or any challenge there, because this is something which is not worse than the rest of the industry or our banks, their own portfolio typically. So that is how we look at it.
So thank you so much for patiently answering the questions. Thank you. And best of luck.
Before we take the next question, a reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. There is a follow-up question from the line of Anusha Raheja from Dalal & Broacha. Please go ahead.
Thanks for taking my question. Sir, what are the returns that you'd be expecting from your AIF book? CRE book which was sold to AIF, given the fact that, the real estate sector has been improving. What are the basically, terms of, profit sharing, there on that side?
So I think until we fully redeem the book, which may be another 2-3 years, it'll be very difficult to take any guess on that. So at this point in time, it's a very difficult question. See what happens if there are 10 investors there. Some will do very well, some will not do so well. And we'll discover the entire thing when the full book is, liquidated completely. Another 2.5 years.
Okay. And so you said that you have still $270 billion of bonds, on your book currently, which are high cost. So those bonds might come up for repricing in this. So in
They
that
are fixed
case,
rate.
I'm sorry,
No, these bonds are fixed rate bonds.
fixed rate bonds. Okay. So, I mean, whenever you redeem that, probably that might get also replaced by lower cost. So you might have a benefit of, margin expansion from that as well.
That's right. Absolutely right, because this 270 million still we are bleeding in terms of cost. So I think when we do that, there'll be some cost of funds advantage there also.
So that might come for in next fiscal FY24.
Yep, mostly in fiscal 24.
Okay.
And we may end up doing a small buyback, but otherwise they will come primarily in fiscal 24 only.
Okay.
See, because what is happening now, the bondholders also are not selling because they know that within 6 months they'll get the full money, so why sell at a discount? And so we don't get liquidity in the market. And then there's no our track record that we have bought back most of the whenever there's liquidity, we buy it back. So I think it will come, it will come one shot on somewhere in April 23.
Okay. And, I missed out to your accounting treatment on co-lending book. If you can just elaborate more on that.
So Anusha, I want to clarify to everyone, this is not a change in accounting treatment. The accounting has always been the same. For the presentation purposes, we have only reclassified it from net interest income to non-fund based income. Don't need any funds on this. So the accounting has been consistent, as we also explained on this call, is that we take the margin on that 80%, which is the bank share, and that was in the interest income. Now it is included in non-fund based income. So it's only a reclassification, not a change in accounting.
Yeah, it's reclassification for only the analyst presentation, but there's no change in accounting.
Okay, sir.
I hope I answered your question, Anusha.
Yeah.
Yeah.
Thank you. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. I wanted to understand, the valuation basis for selling 20% stake to ADIA. When I compare it with other listed housing finance companies, it looks very cheap. So if you can share your thoughts on this.
So I think it's a very difficult question to answer, but so what had happened is that the listed companies, when you compare, there are ones that are outlier and valued significantly higher, but must be a long tail in the housing finance will be valued much lower. If you really look at the valuations for what we got and based on, suppose you take historical book value, I think it was at maybe 3.5, 4 times kind of thing. Sequence C times historical?
No, our same was
current. So I think, but if you really look at the entire housing finance universe, there are one or two companies where the valuations are higher. That is one. Secondly, what happened that, to be very candid, there was also overhang of the parent company's valuation. And thirdly, if you look at our track record, then all the investors have basically made significant multiple on their investment. And we generally, in these days, we want to leave something on the table so that the investors have a good exit. So if you look at CDC, ADIA, Fairfax, or Carlyle, all of them have made a lot of money on our investments.
Oh, okay, thank you. I just wanted to understand, your thought process. Thanks so much.
Thank you.
Thank you.
The next question is from the line of Sharaj Singh from Laburnum Capital. Please go ahead.
Hello.
Yeah.
Hello. Hi, sir. Just
yes, go ahead.
Just a clarification on the earlier question on default protection that we might have to provide on the co-lending book that we originate. So, did you say that the banks have not asked for any such default protection? So, in future they might, or there is no such thing here?
There's no such thing possible actually, as per the RBI policies and guidelines. See, what happens if the banks take any default protection, then they can't claim as a priority sector asset because RBI is very clear that when you're doing priority sector, the loans and the risks should be with the bank. Secondly, the risk is priced in, so I won't give a price also and risk cover also. And so the way all these transactions happen, they are without any recourse in terms of risk. And structurally, there is no other way to do this based on the RBI policy also. See, why is RBI encouraging co-lending? Because banks have a balance sheet and ability to take risk. If the risk has to be taken by NBFCs, then why will you, then the whole purpose is defeated.
Right. Okay. That was the question. Thank you so much.
Thanks.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Kapish Jain for closing comments.
Thank you very much. Thank you very much, ladies and gentlemen, for joining us for our quarter two results call. It was a very intervening discussion with all of you. And for any further queries that you wish to have, please reach out to us separately with the investor relations team, and we'll be happy to connect and answer all your queries. Thank you. Have a great day and happy Diwali to all of you.
Thank you. On behalf of IIFL Finance Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.